This is introduction to ES mini futures, understanding the basics. So if you see here, like what the futures are. So these futures are basically the electronic traded contracts, which represents a fraction of the standard S&P futures, right? So you're not actually trading S&P future directly, but a fraction of it. The symbol is ES, and one contract size for each point it is $50. So if ES moves 5,000 to 5,001, you are going to gain $50 in that, right? So the example is over here. If you see, respectively, like how the index moves, and for each point you are going to gain $50 in that. Now, what are the features over here? It trades almost 5 days every week, and pretty much it does start about 6 p.m. from Sunday, and it goes for an hour of break on the weekdays about 5 p.m. So 5 p.m. it stops, then 6 p.m. it starts. So it goes in that cycle 23 hours, starting from Sunday evening 6 p.m. till Friday evening 5 p.m. That's how it goes. So if you look at the year, this is a very high liquidity, and the bid and ask is very tight. Typically, it moves into a range of 0.25. So you can use it that way. The capital requirement is pretty low as compared to standard futures. Now the uses of it, right? So pretty much it is used in the industry as a form of hedging mostly and portfolio management, but it could be used for speculation. If you are very particular about level to level trading, then few points here and there you can make use of it, right? And this is also help to leverage the large position with a very small capital. So one thing I would like to mention, with ES Mini, which is $50, there is a micro which is $5. So if you want to really trade, put your hands on there. Start with paper trading and get into the deal with micro, not the mini, right? So if you look at the accessibility, right, margin requirements are pretty low. Flexibility is very high. Pretty much you can trade, as long as you want to trade, right? And liquidity is also very high. So in that case, in no case you're going to come across a scenario where you will feel that there is not enough liquidity, right? So if you see how the people are using it, uh, it is kind of I would say risky if it is not managed properly, right? Because it is a leveraged, so you really have to see, like it gets leveraged from both the sides, like gains and losses, right? Volatility, it moves very fast. I would say volatile, but it is kind of like, it's a leading indicator. It moves very fast, and there is a market risk in there, right? So definitely this is not for the beginners, but this could be tried out once you have a portfolio, sizable portfolio, and if you want to really hedge it, right? Last but not the least, summary about it: low capital requirement. We know that it is ideal for trading and hedging strategies which you got high liquidity, and traders should be really aware of leverage and volatility. It's a very powerful tool being used by a lot of institutional investors, as well as some of, I would say not all, but some of the individual investors who really want to deal into that area. Thanks. Bye.